Hey everyone, welcome back to the channel. Today we need to talk about something really important, something that hits close to home for me because it is exactly the kind of trap I fell into when I was first starting out. We are seeing a lot of market movement, some names flying high, some crashing hard, and it is easy to get swept up in the excitement, to feel that fear of missing out, to believe that this time it is different. I have been there, done that, and lost a good chunk of my hard-earned money because of it. Back when I was in my early 20s, I was desperate to make money fast. My family background is pretty ordinary, nothing special, so I always felt this pressure to build wealth quickly. I saw friends, or rather, I saw stories online about people making fortunes overnight, and I thought, why not me? I did not understand the logic behind investing. All I saw was the potential for high returns. It was like a siren call, luring me in with promises of easy riches. I just followed the crowd, blindly jumping into whatever was hot, whatever everyone else was talking about. That was my first big mistake, following the herd, without understanding why. I remember distinctly one of my earliest forays was into short-term trading. Everyone on certain forums was hyping up particular stocks, saying they were sure things bound to go up. I believed them. I poured a significant portion of my savings into these quick trades, convinced I would double my money in a week. I would buy, see a small jump, get greedy, hold on, and then watch it plummet. The emotional roller coaster was exhausting. Every small gain felt like validation, every loss felt like a punch to the gut. I was constantly chasing the next big thing, buying when prices were soaring, selling when they were crashing. It was pure speculation driven by emotion, not by any sound financial principle. I had no risk management in place, no understanding of how much I could afford to lose. I just wanted to win, and I lost repeatedly. Then there were the scams. Oh, the scams. When you are new to investing and you are looking for easy money, you become a prime target. I fell for a few too. Unfortunately, there was one that promised guaranteed returns of 20% a month. It sounded too good to be true, and it was. They had fancy presentations, testimonials that I now realize were completely fake, and a slick sales pitch. I invested a decent sum, believing I had found a loophole, a secret path to wealth. For a short while, I even saw some returns, which made me trust them more. I told a few friends about it. Luckily, they were smarter than me. Then one day, the website was gone. The contact numbers were disconnected. All that money just evaporated. It was a harsh lesson about due diligence and skepticism. If something sounds too good to be true, it almost certainly is. My greed blinded me to the obvious red flags. Another major pitfall for me was what I now understand as poor risk management and overconcentration. I would find a stock or an investment that I truly believed in, but my belief was based on hype and limited understanding. I would then throw all my eggs into that one basket, convinced it was a sure bet. I remember one particular stock. It was a tech company that everyone was talking about. I read a few articles, saw some positive news, and without doing any deep research, I decided it was going to be the next Amazon. I put almost everything I had into it. I mean, everything. I did not diversify at all when that company hit a rough patch, which it inevitably did. My portfolio took a massive hit. I watched my savings dwindle away helpless because I had no safety net, no other investments to balance out the loss. It taught me the painful truth that even if you believe in something, you need to manage your risk. Diversification is not just a fancy word. It is essential for protecting your capital. And the emotional trading, oh boy. This was probably the biggest destroyer of my capital. The market would fluctuate, and so would my mood. A stock would drop a few percent, and I would panic sell, locking in my losses. Then it would rebound, and I would kick myself, or I would see a stock soaring, jump in at the peak, only to watch it correct itself shortly after. My decisions were driven by fear and greed, not by any logical analysis. I was constantly reacting to the market instead of acting based on a well-thought-out plan. It was exhausting, mentally draining, and ultimately financially devastating. I learned that the market does not care about your feelings, and emotional decisions are almost always bad decisions in investing. After losing a significant portion of what I had painstakingly saved, I had my rock bottom moment. It was a wake-up call, a very painful one. I realized that my approach to investing was completely wrong. I was chasing fantasies, not building wealth. It was then that I decided to change. I stopped looking for shortcuts and started focusing on learning. I devoured books, articles, and reputable courses on personal finance and investing. I learned about long-term strategies, diversification, asset allocation, and fundamental analysis. I stopped trying to beat the market every day and started understanding that steady, consistent growth is far more sustainable and less stressful. I shed the get-rich-quick mentality. It was replaced by a desire for steady savings and low-risk investments. I started building an emergency fund, something I had completely neglected before. I invested in broad market index funds, understanding that trying to pick individual winners is a fool's errand for most people, especially for beginners. I focused on things I could control, like my savings rate and minimizing expenses, rather than trying to predict market movements. It was a complete shift in mindset from gambler to cautious planner. My current situation is much different. I no longer engage in aggressive speculation. I approach investing with a rational, measured perspective. I am perfectly content with steady, modest returns. I do not need to be a millionaire overnight. My goal now is to share my experiences, the mistakes I made, the lessons I learned, so that others, especially young people in their 20s, do not have to go through the same painful journey. I want to equip you with the foundational knowledge and the mindset to avoid the traps I fell into. So when we see stocks like Snowflake soaring 30% after their quarterly figures, or a company like Nebus jumping 10% because a well-known investor disclosed a stake, it is easy to get caught up in the hype. Snowflake's numbers look impressive. They beat estimates across the board. They are showing that their business model is working, that AI is making them stronger. That is good for them. But for us, the everyday investors, especially those just starting, it is crucial not to see these stories and think, I need to jump in now. Or, I missed out, what is the next one? That is the exact thought process that led me to make so many bad decisions. The news about Nebus, where 5.6% stake was disclosed, leading to a 10% stock jump. I have seen this movie before. Someone influential makes a move, and the stock reacts. Does it make sense to me? Logically, it makes zero sense. A stock should ideally move based on the company's fundamentals, its growth, its profitability, not solely because one person, however famous, bought shares. When I was new to investing, I would have seen that headline, thought that person must know something I do not, and blindly bought in. I would have chased that momentum, only to potentially get burned when the initial euphoria wore off. It is exactly how I lost money on various insider tips and guru picks in the past. Always be wary of stock movements driven purely by headlines or individual actions. Understand the underlying business first. If you do not understand the business, do not invest. It is a simple rule that took me years and a lot of lost money to learn. Salesforce is another interesting case. The stock reaction was flat. Despite them buying back a lot of shares and showing some growth in certain areas, the market seems to be saying it is not enough. For a beginner, this might look like a confusing signal. Why would a company doing okay not get a boost? This highlights the market's often irrational short-term reactions versus a company's long-term value. When I was starting, I would have seen a flat stock, gotten impatient, and sold even if the underlying business was solid. I did not have the patience to let good businesses work their magic over time. My focus was always on immediate gains, which is a recipe for disaster. The market sometimes overlooks strong fundamentals in the short term. That is an opportunity for those who understand valuation and have a long-term perspective. But it is not about chasing the dip. It is about understanding the business and its intrinsic value. And then there is Meta. This one is close to my heart because I really believe in it, but not for the reasons a newbie might think. It is still down year to date, still relatively flat over the last 12 months. When I was starting, I would have seen a stock like Meta, heard all the negative talk about its capital expenditure, its metaverse bets, and I would have stayed far away. I would have been influenced by the prevailing negative sentiment, missing out on what I now see as a potentially undervalued opportunity. I would have focused on the broken stock aspect, not a broken company aspect. People constantly talk about Meta's high capital expenditure, especially on AI. They worry about the return on investment. I get it. It is a valid concern. But what they might be missing, and what I would have missed entirely back then, is the long-term vision. Meta is investing heavily in AI, not just for some distant future, but because they believe it will make their core business better and stronger. It is like planting seeds for a huge forest. It costs a lot. Now, but the potential harvest down the line is enormous. I remember when I was chasing quick profits, I would never have had the patience or the foresight to see beyond the immediate costs. I would have been too focused on the quarterly numbers, not the multi-year strategic moves. The idea that Meta could eventually offer its AI compute or API services to others, just like a cloud business, is fascinating. Mark Zuckerberg himself has said it is on the table. If Meta were to build a cloud business, the market would likely re-rate it significantly. But right now, they are focused on internal use, on making their own platforms better. This is a classic example of the market often being short-sighted. It does not want to believe a story that takes time to unfold. I used to be that short-sighted. I wanted instant gratification. I could not see the forest for the trees. This is why many people miss out on good long-term investments, because they are too fixated on what is happening today, or even this quarter. The recent news about Meta launching Instagram, Facebook, and WhatsApp subscriptions with more AI plans to come is another signal. A few dollars per month for extra features. This might seem small, but think about the scale. Snapchat, an inferior company in terms of user base, generates over $1 billion annually from subscriptions with just a small percentage of its users. If Meta can convert even a small fraction of its billions of users, we are talking about billions of dollars in high margin revenue. This is a lever they can pull. When I was younger, I would have dismissed this as small potatoes, not realizing the power of scale for a company like Meta. I would have focused on the core advertising revenue, not on new, potentially massive revenue streams. I would not have seen the potential because I was too fixated on the past or the perceived problems. Everyone is worried about capital expenditure. Everyone worries about Reality Labs and its losses. But they often overlook how profitable Meta's core business already is, and what AI is doing to enhance that core business. They forget the company's track record of innovation and adaptation. My personal DCF analysis, even with conservative assumptions, shows significant upside for Meta. The market, in my opinion, is still undervaluing it. When I was starting, I would never have done a DCF. I would not have known how. I would have relied on someone else's opinion or just my gut feeling. Learning these fundamental analysis tools is what helped me move from blindly following to making informed decisions. The chart for Meta shows a nice green candle yesterday, and it is trying to close that earnings gap. These are technical details that I now understand to a degree, but back then I would have seen a green candle and just thought buy without understanding the context. Without understanding the company's fundamentals, technical analysis alone can be misleading and lead to impulsive decisions. Lastly, we are seeing news about drone stocks going up because the Trump administration is in talks with drone companies. This is a classic headline-driven market. Whether it is positive or negative, headlines move names. We have seen it with AI, memory, cloud, and now drones or quantum or nuclear. This is not healthy for the long run. For long-term wealth building, you want businesses to do the talking, not headlines. I remember chasing every single headline when I started. A positive news article about a company, I would jump in. A negative one, I would panic sell. It was a chaotic way to manage money, and it never ended well. Tread very carefully when you start chasing names based on headlines alone. Ask yourself, does this headline fundamentally change the business? Long-term prospects, is this a sustainable reason for growth or just a temporary bump? In summary, there is a lot of noise in the market. It is easy to get distracted, to feel like you are missing out, to believe that you need to be constantly active. I have been there, done all of that, and it cost me dearly. My biggest lesson, one I want to share with all of you, is to focus on the right things. Focus on understanding the businesses you invest in, not just the stock price. Focus on long-term growth, not short-term gains. Focus on building a solid financial foundation with proper risk management and diversification, not on chasing the next hot tip or the latest headline. If you do that, you will be just fine. Hope you found this helpful. See you in the next one.